Hey folks, it's Dave Burrows. I am CEO and Chief Investment Officer here at Barometer Capital Management. And I want to thank you for joining us on our Tuesday webcast. For clients, it's a great opportunity for us to review what we're seeing going on in the world, what's changing in the portfolios, making sure that we are transparent and if things are changing, we'll see them in the pictures. So it keeps us honest. For those that don't know us, it's a way to get to know the way we make our decisions and the disciplines that we use in managing the portfolios here at Barometer. So, there's lots of ways to run money. We have one approach, but basically we're trying to make sure that we understand the big structural changes that are taking place in the market and that we position to take advantage of it. We don't have to be everywhere all the time. The goal is to focus on productive assets and be prepared to make changes when changes are required. So as always, I want to just start from a top-down perspective, taking a look at what's been going on. We have been in a structural bull market in U.S. stocks now since 2013. And when we look at the near-term picture, the market has been working its way higher. So this box is the bear market from 2021 through the beginning of 2024 when we finally made a new high. And through that piece, we talked about the fact that likely this would be something like a 20% pullback back toward this long-term moving average, which is typical, and that it might last 18 or 24 months. It lasted 24 months. And on the other side, you tend to have 3, 4, 5 years before you get to the next cyclical bear market. These bear markets are very different than the ones that we're very afraid of, and those are the big structural bear markets like the tech wreck in 2000 or the financial crisis in 2007, 8, 9. And, we always feel that there's times to be more invested and times to be less invested. But when we're in a good market, our job is to take advantage of things, and we certainly have been in a pretty decent market. When we think about the downside, the red years always stand out to us. But to look at it another way, when you have a year like 2022 or like 2008 or like 2018, you tend to have several years in between where you have solid returns. So it's easy to worry about the down years, and we worry every day about them. But if you're in a constructive market, our job is to take advantage of them. So the low in the bear market was in October of 22. We slowly worked our way back to make new highs, and we've been working our way higher ever since. A few things that we watched. First of all, we're trading above all the moving averages, the 200-day moving average, 50-day moving average, 21-day, even the 8-day moving average. Market's been very consistent. And here we are into December, and it's been a very good year to date. So when we go through month ends, very often if a market's been strong, it was up a little over 5% in the month of November. There is some rebalancing that institutions have to do. And it looks as though, there's pretty significant U.S. equities for sale at month end, about $50 billion. And that's because U.S. equities were so strong, and that gets rebalanced into other buckets. But here we are 2 days into the month, market's basically flat. It's been absorbing whatever selling may be taking place. And there's nothing to say that it has to be done all at once. It can start before month end. But the net of it is things continue to look very, very constructive. When we look at the calendar, we know that December is the strongest month of the year. So on average, 74% of December time periods are positive. And they are especially so when you come into the month having had a pretty strong start to the year. When we look at the percent of stocks in the S&P 500 that are trading above their very long-term moving average, the 200-day moving average, we've talked about this for some time. So long as we're staying here kind of above this 60% number, it means internally lots of stocks are doing well. So as we sit, almost 80% of companies are trading above their 200-day moving average. And I would contrast that with what happened coming into the end of 2021 in the late stage of a cyclical rally, where the percent of stocks above their 200-day moving average started to deteriorate well before the market peaked. So we never know how long things go on for. We've got views. But the net of it is we watch for these kinds of changes, and there is no sign of change as we come towards year end. If we look at the cumulative advanced decline line, or the number of stocks advancing versus those declining, it's a rising number. So the advanced decline line also supports the fact that internally more and more stocks are participating in this market. It's healthy. And then when we look at how overowned the market is, if we look at CFTC non-commercial net positioning, so this is individuals, we can see that through the course of 2023, people were net short, and they have been getting more positive. But this, again, what happens later in a bull market, it tends to be that people get quite long by buying E-mini futures, and really there's no sign of crowding here, so no major concern here. So when we look at the S&P mid-cap index or smaller cap, again, percent of stocks trading above the 200-day moving average is very solid. And when we look at the geometric index, which is 2,900 companies equally weighted, in the month of November, frankly, we broke out of a 2-year range that we had been trading within. And it's not long since we broke out of this range that the value line geometric index was in since 1998. So when we break out of a sideways period in the market and we start to work our way higher, very often that's the beginning of a more bullish period, not the end. So these things sort of continue to line up favorably. Internationally, the Nikkei, has been consolidating over the last 7 months, but when we look at it under the microscope, we came down here to the 50-day moving average in October 2023. We came down here and tested the 50-day moving average in the early summer. We've tested it a couple of times, and it looks as though some of the technical indicators are starting to turn up. So my guess is over the next few weeks, we see a next phase higher for the Japanese stock market, especially given the fact that financials make up such a large part, and banks relative to the Nikkei have really been accelerating. And one of the reasons we like international stocks is there are so many financial services companies, and frankly, they're cheaper than US stocks. There's also lots of industrials, and that makes up a big part of the Japanese market. Also, India, looking at a more near-term chart, did pull back and test the 50-day moving average, is now rallying off it. Looks as though it could get going again. Taiwan is similar. Argentina, boy, is really flying. Now, I only put up Argentina not because it's such an important market, but because it's an economy that is going through a major restructure and a major deregulation. And this can be a really positive thing for stocks if you take out red tape or you reduce the size of government. Ultimately, it's painful for the consumer and there's lots of job loss, but ultimately it can be a really strong thing and seen as positive. So just keep that up just as a reminder, because we know that the new Republican administration is, talking about some pretty significant deregulation and reduction in size of government. So when we look across all of the major global markets, global breadth on the week was up 1%. So the average country increased the percent of stocks and uptrends, still only at 43%. So when we look on a distribution curve, it tends to be when you get late in a cycle, all of the countries will get piled up down here at the right-hand side of the spectrum, meaning a high percentage of stocks and uptrends. US and Canada and Japan, London really the strongest from a breadth perspective, but this is a very normal distribution and frankly has a lot of room that it can expand. The TSX composite in our home market has been very, very solid. Now up about 25% on the year, about 4% ahead of the equally weighted S&P. And that's partly because the sector makeup in the Canadian market does have, significant exposure to financials and industrials, and materials and energy, which have been decent. For the month of December in Canada, again, it's the strongest month of the year on average. Market's up 1.8% and positive over 80% of the time. The one thing that we do want to keep in mind is as we're getting later in the year, some of the underperforming stocks can do a little better as people get through tax loss selling, but certainly there can be pressure on the losing stocks leading up to the late part of the year. When we get to fixed income, certainly I think that we continue to be in a bond bear market. Yields have been moving higher here since the mid part of 2020. We've seen a series of higher lows and rates. And the TLT, which is the indication ETF for the long-term US government treasury bond, is still way, way, way off the highs. Really, at this point, no prospect of getting back toward that number, trading below virtually all of the moving averages. So we continue to be quite cautious here. And that's because, as we've mentioned, if you look at the history of inflationary waves, there tends to be a first wave and a correction in inflation, and then a second higher wave. And we're getting to that point. If you look at it another way, US core PCE inflation year over year, when ultimately you break out to a new high in inflation, when you get a pullback, just like in a stock chart, very often you pull back to the point where it broke out. And this is where it appears to be troughing. So we'll see, but there have been several countries that have started to report inflation data that's coming in just a snick above expectation. And we do have a lot of populist governments around the world, and their willingness to spend money to win favor does not appear to be going away. When we look at inflation for this cycle, versus the inflation cycle for 32 to 39 or 45 to 52 or 67 to 74, again, when we line up the timeline, this is kind of where we would expect to see some resistance to going lower, which would make it awfully tough for the bond market. Now, on the other hand, we've talked about the fact that in an inflationary environment, we would prefer to own equities, and certainly S&P 500 relative to the US long-term treasury continues to work its way higher. So on a relative basis, stocks over bonds. And in an income portfolio, if we compare dividend growing stocks in the RDVY ETF versus the aggregate bond index, again, dividend growth continues to outperform bonds, which makes this the most attractive neighborhood. When we compare dividend growers versus high dividend payers, and high dividend payers don't tend to have as much dividend growth, again, dividend growers are outperforming high dividend payers. So those would be companies like utilities and telcos and REITs and consumer staples. The high dividend growers continue to lead. So over the course of the year, the equally weighted S&P up 20, the US bond index up 3, the Canadian bond index up 4.8, the corporate bond index up 3.8. The Barometer Discipline Leadership Income Fund is up a little over 27%, and we're very pleased with that. So moving on to commodities, as we talked about, commodities appear to be starting a second leg higher following the first one through 2020 and 21. That is a more inflationary indication. So often money flows here in a more inflationary environment. We've talked about the fact that gold's been very strong. I've been asked over the last couple of weeks, do you think that's it? I go back to the last gold bear market where it eventually broke out, and each one of the rallies got to 80% above the 200-day moving average, and today we're only 37% above. My guess is we have a long way to go here. So commodities relative to bonds outperforming, making new relative highs. So look, our job is to manage risks. And it's very clear right now, based on what's happening in the market, that the risk is inflation eats your money, not that prices fall. And so in a disinflationary world, it makes sense to focus on fixed income. In an inflationary world, it's owning assets that have an ability to maintain your purchasing power, and stocks and commodities are more highly correlated to an inflationary world, and that's what's happening in the market. So of course we don't want to fight it. Just on Bitcoin, again, I've been asked, had a good bounce over the last little bit. Is that it? We think it's relatively early days. After each one of the bear markets we've seen, there's been lots of running room, and think it's probably pretty early. So there's where we are. We've had 1 month of advance out of this consolidation. The last bull market had 5 straight months, actually 6 straight months of advances. The bull market before that, more like 12. So it may be this is it. My guess is probably, again, it's got some room to move. So we don't have to be everywhere. We've got to pick our spots. Our job is to try to identify the assets that are being revalued. That could be sectors or themes or geographic regions in the world. It could be asset classes, but to try and target assets that are participating, that have a tailwind where money is getting put to work, to look for new signs of leadership that might be emerging, to recognize when old leadership starts to recede or fail, and be prepared, to make changes, to be tactical along the way. And that includes holding cash in the event that we can't find leadership. Now, over the course of this year, that really has not been the case. We've seen lots of leadership. From a top-down perspective, 80% of return comes from getting to the right neighborhood. We look at all of these groups to try to identify a few that are seeing net inflows of capital. At the beginning part of the year, there were 2 or 3 groups that look constructive. There's 8 or 9 themes today that are behaving well. So that's constructive. That's more and more leadership. From a bottom-up perspective, we try to find specific securities to use to express our view within those groups. And we're trying to find, strong stocks within parts of the market that are seeing expanding breadth. So where we can find companies that are good getting better, and they are in parts of the market that have a tailwind, well, this is where our portfolio should live. And then, of course, the last thing is we have to maintain a very disciplined approach to pruning out the bad inventory. There are going to be things that work for a while and then stop working. And as opposed to saying we're going to be patient long-term investors and hope for the best, our job is to make sure that little mistakes don't turn into big ones. So when breadth starts to deteriorate, or stocks don't perform the way that we are hoping or expecting them to, then we have to be prepared to raise a bit of cash, right? And tighten up the stop losses and be disciplined on our way out, so that we make sure that the inventory that we have sitting in our client portfolios continues to meet our tests, right? We want to reevaluate every position every day, our sector weights every day, to say, should something change? Is something changing in the market? Are we recognizing it? Okay, so where do we sit? From a big picture perspective, breadth, or the percent of stocks in uptrends globally, is expanding. We saw, if we go across all major markets, it was up about 1.5% on the week. We saw improvement in the US, we saw improvement in Canada, we saw improvement globally. When we look at the shorter term perspective, percent of stocks trading above the 50-day moving average is strongest in the US market. But we also are seeing improving percent of stocks with positive weekly momentum, meaning upward trajectory. More stocks making new highs than making new lows. That number of percent continues to expand. And the percent of stocks trading above their 150-day or 30-week moving average, again, continues to expand. As long as this is the case, as long as there's lots of green on the screen, we should probably be pretty fully invested. Now, the NASDAQ 100, which has been a leader over the course of the last couple of years, has not been making new highs recently, and has had fewer stocks above the 200-day moving average. So we're a little cautious here, but we don't have to be bullish everything. So let's look at sector leadership. Financials continue to be very strong, as represented by the XLF, which is the broad-based financials ETF in the US. We've had months on months of strength. In the beginning of this month, we have probably seen a little bit of profit taking, and that's just, this group has been a beast. But we have to remember, really, if we go all the way back to the mid-2000s on a relative basis, the bank index versus the S&P 500, underperformed for a long time, and only recently, in the last 18 months, has been showing relative outperformance. Now, we highlighted last week that the difference in valuation between the S&P and the bank index is significant. It's like 10 multiple points. So the fact that it's outperforming, there's a long way that it can go before it would be expensive relative to the market. Now, if we look at exposure inside hedge funds as a percent of total US exposure, again, it's very early days in a shift in power here. So we can go up a long way in exposure before it winds up overowned in institutional portfolios. The Canadian banks have been on a tear as well. Be interesting to see this week the bank results. Bank of Nova Scotia reported that's a bank we do not own. It did disappoint mildly. It's had a tendency to do that over the last few quarters. So it was down a little today. National Bank is trading right at the highs. Commerce Bank trading pretty much at the highs. We get the remainder of the banks reporting over the course of the week. So we'll see how that goes. But my guess is, the strong will continue to be strong. On industrials, a relative strength has continued to improve. This is the equally weighted basket of industrial companies. You can see that, these are weighted sort of between 2 and 3%. We've had a lot of exposure here. We have, I think it's about 15% of firm assets in industrials. And we've talked about a number of our exposures over the last few weeks. But I've asked James Callahan to jump on today to talk a little bit because, frankly, this is a group that's been performing really well, can continue to perform well. We've seen recently the percent of stocks in uptrends expanding nicely over the last few months, continuing to show us leadership, almost 90% of stocks in uptrends. James was on recently to talk about BWX Technologies, which is in nuclear power, small nuclear reactors. We've talked about Crane. We've talked about a number of different companies, but today I've asked him to come on, talk about GE Vernova, which is a company maybe a lot of people aren't familiar with. It's almost $100 billion company, and it comes out as a result of a spinoff. So James, give us sort of your investment thesis here.
Yeah, thanks, Dave. It's always a pleasure to join, and especially to talk about some exciting names like this one specifically. So GE Vernova, it's a name that's been on our farm team for a few months. It's acted really well. We've just been looking for the right entry point when it made sense in the portfolios, and that happened recently, which is great. So now it sits in our equity and GTA mandates. So GE Vernova, we like them because they sell and service natural gas turbines, which is a great growth industry, one for which the outlook has improved dramatically over the last year or so, with a change in the White House and with data centers demanding more power. So the name's a great way to play electrification, growing electricity demand. Data center energy demand growth has been something that we've talked about plenty over the last year. Many regular listeners to the call will have heard us talk about nuclear exposure through this lens. As you mentioned, BWXT, another great name, and GE Vernova and BWXT actually work together on projects, which is great. And so with a long-term outlook, nuclear likely wins through this vertical. But in the short term, that incremental demand is going to be filled almost solely by natural gas. So we're thinking large incremental power demand coupled with potential production growth in natural gas that could move prices lower. Looser environmental regulation sets up a great environment to invest in the companies that make equipment to turn natural gas into electricity, and GE Vernova really is the best name here. They
So
have the
James, just to jump in there for a second. So, we've talked about nuclear power, and we've talked about before liking to invest in picks and shovels of a theme. And if we know that we need a lot more electricity, and we know that the long-term future may rest more on nuclear, natural gas is one that in the near term we can put electric capacity into production fairly quickly. And so talk a little bit about the products that GE has that really serves that market.
Yeah, so I mean, they have a few different business lines and products, the most important of which right now is their power segment, where they do everything from smaller natural gas turbines that can be a little bit more mobile and can be deployed on remote sites, for example, plugged right into a natural gas supply and run. And then they do the biggest, gigantic utility grade natural gas turbines as well. So that power segment, which is the reason why we like them here, right now it sits just over 50% of revenue. It's a bigger percentage of their backlog, which we can get into. We can get into their backlog if you think it's relevant, Dave. So
Yeah.
I guess,
I think that that's one of the interesting things, when we looked at BWX, we thought there was lots of opportunity with small modular reactors, and there is. But they had this tremendous solid business of government billings for the services that they provide to the nuclear submarines and the nuclear reactors on the naval ships. And there's some similarities here in GE Vernova.
yeah, they're very similar. And maybe I'll just take a step back and just describe exactly what we mean when we're talking about a backlog. So backlog for GE Vernova specifically, when the company uh, is contractually obligated to receive revenue in the future, for example, if I sign a 10-year service agreement, I grow my backlog by the amount of the total contract, and then I earn that revenue over time as I provide the service. So when companies report their backlog and their backlog grows quite nicely, it helps analysts know with a very high degree of certainty what the company's revenue is going to be in years to come. So companies with big growing backlogs generally will trade at higher multiples. And when a company is growing their backlog and the backlog is majority service revenue, which specifically for GE Vernova comes at very high margin, inside of their power business, their backlog is 80% service revenue, very high margin. So that the fact that they're growing this makes them a great multiple expansion candidate and justifies trading at a bit of a higher multiple, but justifies further multiple expansion as that backlog continues to grow.
So very, very good visibility in the business. So, I mean, I think that this is a theme that we want to continue to focus on. Power is not going away. One way to do it is through utilities, and we do have some exposure to Southern Company. However, these companies have more leverage ultimately to the business and have sort of a greater opportunity over time to grow. And very often when companies get spun out, as GE has spun these pieces out, they set them up for success. And so they very often trade well. Some people wind up with them in their portfolio. They don't understand what it is. They have a small piece and they sell it out into the market. But once that gets washed out, institutions start building positions, and very often that goes on for a while. So just an interesting add to the portfolio.
And this has been a perfect example of that spin-off dynamic, Dave. Like the company is very clean right now. They've gone from the two business lines that matter, power and wind, being substantially unprofitable in 2018. Now both business lines are very profitable. They're growing margins in both business lines. And I guess to talk about this name is particularly topical right now. They sit ahead of an investor day next week, actually exactly at this time. Um, I can talk through some of the things that we're expecting. We're expecting to see increases to long-term targets, which is always very helpful. So they're expected to raise their revenue growth CAGR between now and 2028 to high single digits from mid single digits. They're expected to take margin guidance up from 10% to above 14%, and that should continue to expand over time. The guidance that they'll give is likely very conservative. But then something else that we're pretty excited about, we do hope to see, are some details around their capital allocation program. So that's including the initiation of a dividend and the implementation of a buyback program, which we of course love to see. These are the seeds of dividend growth companies when they're steadily growing profitability and start to initiate dividend payment, which is great.
Yeah, well, certainly something that we're looking for in all of the portfolios and all the portfolio holdings. Dividend growth, we think fits really, really well in this theme. Great, James. Thanks so much for jumping in. I really, really appreciate it.
Thanks, Dave.
So just to move on, materials after consolidating for 4 or 5 months are starting to break out, starting to get a little bit better. We had the mining ETF, metals and miners, which includes steel, make a new monthly high last month, which, I mean, to put it in context, hasn't made a new monthly high above 2012 in 12 years. So again, that looks like it's the beginning of something. Agnico, which had pulled back, as many of the gold stocks did after a big run up through the summer and in early fall, has made a really nice turn and is charging back, is up about 4% today. Gold and silver looks like it's starting another leg higher. The uranium stocks continue to behave really, really well. This is Cameco. And again, putting it in context, 3 big months higher, moving it up and out of a range it's been in since 2007, probably something earlier. And one of the groups that we're watching closely are the copper producers. And they, to be honest, have been disappointing so far over the course of the year. But when we look at on a shorter term basis, right in and around that 50-day moving average, we've now had We've now had 4 months moving slightly higher. We'll see whether we can get up and out of that range. One of the companies we're watching is 4N Mining, which is a smaller cap company that has really interesting prospects in Saskatchewan. You can see it moved up and out of its long-term range. I think it goes back 20 years in 2022, and it's been consolidating. If we can get up and out of this range, probably there's lots of upside here, so there's something to keep an eye on. From an energy perspective, we talked seasonality. Second week of December tends to be where they get stronger. It happens to be it's just moved out of a 2-year sideways range. A lot of concern from clients. What do tariffs mean for the energy producers? We think realistically, while the saber is rattling, Canada represents 61% of the imports of crude to the US. The US refiners are dependent on the heavy oil to mix with their light sweet crude to get the right mix in the refiners. So we don't think that likely this is something that is ultimately going to attract a big tariff, but we'll have to see. In the meantime, the large cap energy companies like Imperial Oil look really, really constructive, having come out of big consolidation ranges. So great dividend growth, and some volume growth happening at a time of year where we really are at the bottom of the seasonal weak period. And December tends to be strong. And of course, then January, February, March, April, May, June. So again, this is kind of a timely sector, something that we're watching. In power, clean energy continues to be very weak on a relative basis. Communications have had a nice lift over the last couple of months. They've been moving their way higher. These are companies like Meta and Google and Netflix. Been a strong performing group. And consumer discretionary, frankly, has surprised us a little over the last 6 weeks, had a nice lift in relative strength. Largely, it's been sort of more defensive consumer discretionary stocks, but the percent of stocks in uptrends over the last 2 months has moved up now to 76%. So internals are getting better here. We're certainly watching it. Costco's been a great holding for us here. Healthcare continues to look weak. Nothing really to do there. Technology relative performance continues to be kind of sloppy. Semiconductor index, is one that we've watched closely, and as you know, have reduced our exposure down to one company, NVIDIA. Software has been the strength within technology, and so obviously it's a group we're watching. Cybersecurity is kind of interesting. We do note in the month of November was the biggest outflow from technology, media, and telecom in the last 4 months. Also a big flow out in defensive stocks, and you can see it. REITs relative strength has been weak. Utilities relative strength has been weak. And in general, low volatility, high dividend stocks relative performance has been weak. So this continues to be a market where there are haves and have-nots. Continues to be a market where, as an active manager, you can make a difference. We are focusing on sectors that have a high percentage of stocks in uptrends, industrials and financials, sort of part of that. And at the other end of the spectrum, food, healthcare, drugs, generally weaker groups to stay away from. But breadth for the average sector moved up 1.4% of the week, continues to be more constructive. So over the last 18 months, as the market has broadened, the equally weighted S&P is up 38%. The all-world ex-US index up 24%. The equity portfolio is up 43%. Our income portfolio is up 43%. Our global portfolio is up 43%, and our global macro portfolio is up 27%. We're really pleased with how things are going. From a weightings perspective, it continues to be targeted towards financials, energy, industrials, and materials. We have a significant underweight in technology and a significant underweight in the defensive sectors like real estate, utilities, consumer staples. This communication services has come up a little bit. You see that the performance is better, and we're certainly looking at consumer discretionary to see if there's something we should add. We are concerned that if inflation starts to pick up, this could be a group that is under some pressure. So we're a little bit cautious there. Things that we watch for signs of risk. High yield bond spreads, the extra return a bond investor expects to take corporate risk versus government risk, continues to come in. Investors continue to favor corporate bonds. No sign of concerns about credit risk there. Volatility has a tendency to trade in a lower range during cyclical bull markets. And that's exactly where we sit today. No sign of major strain on the market. And we are still only about 11 months into a period that could be several years before the next major correction. We've highlighted that when the market's up 20% 2 years in a row, which it's done many, many times, very often it continue on. And we liken this market to 1995. In 1995 and 6 was very strong. 1997 was even stronger. And 96 and 97 strong, 98 even stronger, 97 and 98 strong, 99 even stronger. We aren't in the beginning of a secular bull market, but we are within the middle of it. And we think there's lots of room for this market to continue to grow. And you got beyond 2 years of a bull market without a major correction. On average, you got 5.5 years before the first major correction. And to put it in context, strong years come in bunches. So one last thing I wanted to show, I think is relevant. I talked about this, I don't know, a couple of years ago, when the 10-year average return was down around 7%. We know late in secular or long-term bear markets, you get down to the point where the 10-year return has been close to zero. And when you get late in a secular bull market, the 10-year return tends to be upward towards 20% before things roll over. And so when we look at it today, the market's up over the last 10 years an average of 13%, which is a great number. But it's not 19. It's not 22 as it was in the late 1990s. It's not 21. So we do think that there is room for this market to continue to grow. In the very short run, Decembers during a strong year tend to be strong. So there's not a lot for us to do. The themes that we're in have continued pretty consistently through the course of the year. We watch for signs of weakness. If we started to see weakness in some of our indicators, we'd talk about them next week, and we'd be doing something about it. In the meantime, we're pretty fully invested. So probably it'll be a little quieter through the month of December. In years like this, things tend to settle down. There will be people who are behind their benchmark who are trying to find ways to scrape out a positive for the year. We're going to try not to do too much. So we'll keep on doing these webcasts through the end of the year. And if you've got any questions, certainly happy to answer them. Okay. So can you please tell me what GUTI sector is? It's likely, and I don't know exactly what you're referring to, but it's likely the utilities sector. Jerry asks a question. For the sector breadth chart, can you please explain the meaning of the background colors? What do red, yellow, and green mean? That's a great question. In the absence of putting it back up on the screen, what I can tell you is this. On the sector breadth chart, first of all, it's a distribution curve, and these numbers along the bottom are percentages. So it's measuring the percent of stocks in uptrends. So here down, you can see the banks. Between 80 and 84% of all the bank stocks are in uptrends. You can see it's in capital letters. Capital letters mean that the percent of stocks in uptrends has been expanding. So on any of these where you got capital letters, breadth is expanding. If it's in small letters, it means there's been some contraction, real estate, for instance. The colors are relative strength over a period of time versus the market. So the very strongest sectors would be those that are green and in capital letters. So you can see retail has been improving. Its relative strength has turned positive. It's in capital letters. Breadth is expanding. On the other hand, while breadth in semis has been getting a little better, it's been relatively underperforming. So there's a number of measures here, and I know it's a little bit confusing, but net, The way I look at it, the strongest sectors are piled up at this end of the spectrum. The highest percentage of stocks are participating. When a high percentage of stocks are participating, it's easier to make money within the sector. I hope that that's not too confusing. Lawrence asks, how do you increase a position that is rising? For example, Fairfax. When do you buy more? And when do you pick your spots? It's a great question. Well, first, sometimes it's a question, do we have cash? We haven't had a lot of cash recently. Sometimes it's when it has a very small pullback into natural support, which gets us a better risk reward when putting on the position. Sometimes it is because it starts to relatively outperform more and we have room to add more to the position. So it's sort of a multifaceted question. We don't buy major pullbacks. Those would be more likely to be sold. But we do like strength. We like it when a stock finally makes a new high. If it's been trading in a range for a period of time, that generally means that every shareholder is happy, and you're going to get other people stepping in to put on a larger position. Question, what's your thoughts on onshoring in the US going forward? Would Rockwell or ATS be interesting choices? So we are big believers that there is going to be continued onshoring. It's something that we've talked about over the course of the year. It's one of the reasons why we think industrial companies are interesting. There's also a lot of more domestically focused industrial companies in the small and mid cap sectors. So that's something that we're taking a look at. And you have to pick your spots. So yes, it's a theme. Yes, we're focused on it. And companies like Crane, for instance, which we own, CR is a good example of that. Looks like industrial holdings went up. Curious what you recently added. Well, GE Vernova is one of them. James talked about that today. But they also naturally are going up organically as a relative percent of our portfolio. What other questions do we have here? Oh, GUTI. Sorry, Lawrence, that's gas utilities. GUTI, Lawrence asked again, it was on the far right of the sector of the sector distribution down here. So gas utilities, that is more like pipelines, gas pipelines. And yeah, they've been performing well, but also some of the gas actual utilities themselves have been performing well because of the expectation that gas utilities can be put up more quickly and will be part of the solution for the power that's needed to fuel electric vehicles and data centers. Got a question on a place to safely park a sizable amount of cash for a period of 1 year or more. Time frame and risk tolerance is a big question there. Certainly happy to have a conversation about that. Don't hesitate to reach out to me on that. Maybe this isn't the right forum, but happy to have a conversation there. And boy, lots of questions today. Larry asked on Axon, investors have trouble appreciating high trailing PE stocks, meaning that the price earnings multiple is high based on its trailing earnings. But if it's growing rapidly, it may well be that the future earnings are much lower. Can you tell a little bit more about what you think the company will do from an EPS growth perspective to justify the run-up in price? Look, companies that are showing acceleration and growth can trade at higher and higher multiples. Now, James, you may be on here still. If you are, maybe you have some thoughts on that.
Definitely. I'm always very happy to talk Axon. It's not a name that we've covered recently. And I'll say, the nature of the company has changed since the last time that I've been on to talk about it. And it really comes from growth in their software business. So in this case, to Larry's question, I think the growth in EPS comes from a higher mix inside of their software business, which includes some things like an AI report generating software, as well as the software overlays to their body camera business. So what I've seen from analysts and from expert calls and stuff like that, guys that have dealt with police departments, their AI report writing software has seen huge amount of uptake because it better enables police departments to utilize officer time. So and I think that just speaks to their product innovation. So there's lots of things that they can do for growth, but to put it simply, I would say as the software mix increases, that we'll see earnings increase as well, and that's a really high margin business, and so EPS grows on the back of that.
Yeah, and very predictable, right? Very predictable.
Easy to model.
Good. Well, listen, thank you very much for joining with us. If you got questions we didn't answer, as always, like don't hesitate to reach out. We're always happy to talk to people, clients or other folks. We're in the business of growing the company, and we have a nice growing list of families that we're working with, and we appreciate all of the opportunities that we get. So, James, thanks for joining this week.
Thanks, Dave.
Thanks everyone for tuning in, and we'll look forward to doing this again next Tuesday. Have a great night.